Hey everyone, welcome back to your channel name. Today we're diving into Golub Capital, a powerhouse in private credit. Can its stock hit $1,000? Well, spoiler alert, Golub isn't publicly traded, but we'll analyze its business, strengths, weaknesses, and what its publicly traded arm, GBDC, means for investors. Plus, we'll look at its future and dividend potential. Let's get started. Golub Capital is a leading middle-market lender, managing over $70 billion in assets. It provides loans to private equity-backed companies in sectors like tech, healthcare, and consumer services. Its publicly traded business development company, GBDC, gives us a window into its performance. Golub's strength? A diversified portfolio of over 300 companies and a focus on low-risk, senior-secured loans with default rates around 1 to 2%, well below the industry's 3 to 4%. Let's break down Golub's pros and cons. On the plus side, its expertise in middle-market lending sets it apart from big banks. It earns steady management fees, 1 to 2% of assets, and has a diversified portfolio, reducing risk. Its conservative approach keeps defaults low, but there are risks. Rising interest rates could hurt borrowers, increasing defaults, while falling rates might squeeze margins. Golub relies heavily on private equity deals, so an economic slowdown could hit deal flow. Plus, as a private firm, its financials aren't fully transparent. Since Golub isn't public, let's look at GBDC's financials. It boasts a 50 to 60% net investment income margin, with $300 million in 2023 from $600 million in revenue. Debt is manageable, with a 1.0 debt-to-equity ratio, and interest coverage is strong at 3-4x. GBDC pays a juicy 9 to 10% dividend yield, about $1.48 per share annually, with modest 1 to 2% yearly increases. It's not a dividend aristocrat due to past cuts, but its payouts are sustainable, covered 1.1-1.2x by income. Looking ahead, Golub is poised to grow. The private credit market could hit $2.5 trillion by 2030, and Golub's focus on tech and healthcare lending positions it well. It's also leaning into ESG investing, which could attract new capital. But watch out for risks. Tighter regulations or a private equity slowdown could hurt. Compared to competitors like Ares Capital or Blackstone secured lending, Golub's conservative strategy is a strength, but its smaller scale might limit growth. GBDC's 8 to 10% annual returns, driven by dividends, lag the S&P 500's 10 to 12%, but beat bonds 4 to 6%. Short-term, expect 10 to 12% returns. Long-term, 8 to 10% as competition grows. Golub's a solid pick for income investors, but don't expect $1,000 stock prices. It's private. Subscribe for more finance deep dives and let me know what company to analyze next.